Thank you, Mr. Chairman. Our committee looked at tax structure, and specifically what we talked about was incentive structure as well as optimal tax policy and tax structure going forward. There were four things we came up with, and then really those kind of fall into two themes, which I'll close with. The first one is the legislature should give serious consideration to the governor's commission's recommendation on tax credit reviews, tax credit reform, specifically in the area of looking to streamline the process and make the programs less cumbersome. One of the things that we heard is about how when we go through, or when DED goes through and puts forward a proposal in terms of an incentive package, their proposal will literally be 25 pages long, where other states like Kansas may be a page and a half. And the difference is we have 60 plus programs we're trying to utilize bits and pieces of, where other states may only have a handful of programs but have greater flexibility within that. And clearly that's becoming a challenge as we move forward. That was number one. Number two is right now, I think being led by DED is the Missouri Strategic Initiative for Economic Growth. And specifically what they've done is they've identified areas where our state should be very competitive, and they're building strategic plans and tactical plans around how to move those forward, both from an executional perspective, from an incentive perspective, where in our state, from where in our economy of our state can we lead the nation, and then let's target our efforts there. That proposal, those plans should be done sometime around the end of March, and we believe whatever those recommendations are should be incorporated into our public policy moving forward. We understand that, as we all talked about before, the corporate franchise tax has often plagued our state. It's actually a form of double taxation. Senator Smith, I believe, has filed legislation to repeal that or definitely modify it. So I guess we're proposing that we move his plan forward. The final piece of this actually comes into optimal tax policy. And specifically, as many of us know, there have been put forth through the initiative petition process 9 different versions of eliminating the income tax and moving to a flat tax, fair tax, whatever you call it. The reality is if something like that were to pass, it would impact approximately 66% of our state general revenue. We believe the Joint Committee on Tax Policy or some organization, we thought the Joint Committee is a very logical one, that's comprised of both the House and Senate members, needs to get out in front and start understanding this, understand the real world impact to us, not only of what does this mean from a financial perspective, get some of our folks working on what we believe the rate would need to be, what's going to be taxed, what's not going to be taxed. Basically, what is optimal tax policy moving forward? If you were going to go create, for lack of a better term, if you're going to go build a new state and implement the optimal tax policy to drive your economy, what would that look like? And then let's have the discussion about how do we get from where we are today to that point. And understanding these aren't things that you get resolved in this session, but the reality is there is a very strong initiative moving forward with both technical understanding and the financial resources to move a proposal like this. If the legislature or some organization does not get out in front and start understanding what that means, the potential you could have a very positive impact, or it could be a very negative impact, but nobody knows. Basically, to sum it up, as we move forward, our state needs to look to simplify the toolkit that's used for business decisions, meaning the incentive process, because by utilizing technology and the speed at which companies are operating today is a much faster endeavor than ever before. And so having to go through and pick bits and pieces out of 60 plus programs no longer works, and we're going to have to give greater flexibility to the decision makers. In this case, whether it's DED, whether it is partially into the governor's office, but the whole debate became how do you balance entitlement incentives and discretionary incentives as we move forward. The other piece is, and this is just more editorial than it is something that we need to do. I would not advocate we do it. But if you looked at what's happening in states around us, and you can look at Kansas last year, you can look at Illinois this year, the reality is that we're in a world, whether I like it or not, or any of us like it or not, where economic incentives, that is the competitive process which we use to to bring companies to our state, encourage companies to stay in our state. And what's interesting, if you use Kansas, which over on my side of the state we hear a lot about, they have all these great programs that they do a good job of recruiting companies out of Missouri into Kansas. What's interesting is last year when their budget got tight, they went in and raised taxes. Actually, I believe it was the sales tax is what they increased, which essentially you're taxing individuals, taking those dollars and giving them to companies. And our overall theory is the one thing that we don't want to do is we don't want to put ourselves in a position where we're forced to raise taxes on the people of the state. And so I think that as we go forward, our fundamental understanding has to be we're going to have to reform the process that we used, because the world of tax credits no longer facilitates the incentive structure necessary to compete going forward. And that means there's going to be dramatic changes in all of this. And if there's any questions, I'm happy to answer them.
Any questions of Senator Lager? Senator Callahan?
Senator Lager, I appreciate your work on this. As far as the governor's task force this summer, I don't have that in front of me. How much, if you adopted that plan, would that result in savings? Was it around $200 million?
I think that's when it's totally phased in. I think it's going to be several years before that happens. I think initially, it's probably smaller numbers, 25, 50 million your first year, and then you're going to graduate up from there.
And then, and that commission, and correct me if I'm wrong, and Director Kerr last year during the rebooting on this issue, Director Kerr brought forward a plan, and generally they recommended caps on some programs.
Yeah, last year, and Senator Dempsey led this effort last year. Essentially, at the time when we started, that was when Director Kerr had brought that proposal forward, which kind of dominated the discussion from there on. But caps and sunsets were the way that they had recommended to try to manage this. And the other piece of this that they talked about last year that we didn't talk about as much this year, but still relevant, is the world of incentives today is no longer about tax credits, meaning getting your money after the fact. Everyone today wants cash up front. Right. And it's more about front loading capital than doing it, once the
deal closing fund that we've contemplated.
And that's one of the flexibility pieces they've talked about, right, where at the end, if it's us versus one other state and they're negotiating, that gives them the ability to do that. So I'm not sure.
The committee. Well, I guess did the committee just? I mean, your committee on rebooting said we should look through and evaluate the task force plan.
Yeah,
I guess you also sort of talked about the concept that Director Kerr laid out last year.
Right. As we looked at the Tax Credit Review Commission's work, we clearly couldn't get to consensus on it. But the reality is there are pieces and components of that I think we all can agree upon. And then I think that there are other pieces that are going to be just literally public policy debates going forward.
Did your committee recommend that we should file a bill as a vehicle to begin doing that, or is that too
we didn't
mechanical?
Recommend any bill, but what we believe is as we move forward with our tax policy discussion, whatever that tax policy looks like, whatever the incentive structure looks like, we believe that that commission has done a lot of work that should be included in that process.
Okay. All right. Thank you.
Senator Stouffer.
Senator, I saw a really interesting set of research over the weekend where it showed that more than 40%, I think 43% of job growth is in the companies between 10 employees and 100 employees, and that the way to really grow economic development is to take away the barriers that keep those companies that are already established in your community. This had to do with rural development, but those companies, instead of enticing companies to move and stealing jobs from one entity to another, to take away the barriers and help those companies grow from that 10 to 100. That it was number one, they're already there, and number two, it's a whole lot cheaper to do that. And I think 43% of the job growth across the nation was in that group of companies that are growing and just need help. And so I think it made a lot of sense to me. I've got those figures probably.
I'd like to see that article, but that's going to take a complete rethinking of our process.
I know.
Right now, the majority of our tools are all for companies of 100 employees or over.
That's the reason I brought it up, because I think that could be very fruitful ground in those companies that have established themselves. They've gotten up to 10 employees or more, and then that growth to 100 is that's where you can get wide reducing unemployment.
Thank you,
Senator Dempsey.
Thank you, Mr. Chairman. Senator Lager, I know you've tracked this before. What do you know what the size of the tax credit liability is right now?
I don't. My understanding, and actually Brian Schmidt and I talked about it just the other day. My understanding is DED is updating those numbers, and
it was like over $2 billion.
Yeah,
like last year.
Last year it was $2.2 billion. The question now is many of the projects that are counted in that $2.2 billion, DED has gone back and said, okay, they're never going to happen, so we're going to take them off the books. And so now what they're trying to do is give us a more accurate picture of what they think realistically could actually occur.
And that kind of gets to that point that you made earlier about, well, you can enact the tax all of the tax credit review commission's changes tomorrow, and you wouldn't have $200 million in
That's
savings.
correct.
That's where over time you can get up
there
to that. But as we look at it from a budget perspective this year, there's not $200 million in savings.
If we wanted real financial savings, if we were doing this because we want real financial savings, we should have done it 2 years ago.
It's kind of like pension reform.
That's right.
It's over time. There's of great benefit to the
That's
state
correct.
from a budget perspective.
Not to mention the fundamental debate about, are we going to continue to live in a world where we're using an incentive structure that was more relevant in the 80s or the early 90s versus 2010?
I agree with you on certainly on that part as well. Thank you.
Senator Lemke.
Thank you, Mr. Chairman. Senator Lager, I'm curious if there was any testimony when looking at, taking a global look at our tax policy in the state. Was there any comparison to states that are of similar size, similar population, where we were comparing, apples with apples? And the one that comes to mind for me is Tennessee. Did the committee have any testimony as far as the tax policy in Tennessee and the direction they took 30 years ago, which was a different direction than we took in the state of Missouri?
We did not have that type of testimony in this committee. That is the type of testimony that we believe should occur in that, whether it's the Joint Committee on Tax Policy, whatever this group is, that we formally give them a charge of saying, you need to go understand and figure out what is optimal tax policy, for the next 30 years, not the previous 30 years.
Right.
That is the type of stuff that needs to happen. That someone has to take the charge on.
And my understanding, if you look at the history of our state, the state of Missouri, that you can see decisions that were made by the people that were in this building that affected the way we did business and our revenues. And usually it's looked at every 40 to 50 years.
Right.
And the time is now, and I think it's very important, that we have some in-depth look at our tax policy.
Well, you actually bring up a valid point, and though we don't often talk about here, and that is, we have all these tax credit programs. One of the reasons we have so many tax credit programs is because in the late 90s, when revenues were flying off, they couldn't give the money back fast enough because of Hancock. One way to get around that was through tax credits. And so that became a tool to help deal with, at the time, their problem of revenues growing faster than the Hancock limit allowed. And so now we've just, over time, evolved to this point where, although the intentions were good then, the changing of the economy and the changing of the way our tax and our economy and our tax structure works has dramatically changed what we need to do from this point forward.